Good afternoon, everyone. Thank you so much for joining us for this event. Really appreciate you joining us very early. We are just trying to allow another 1 or 2 minutes to let the room populate a little bit. So please bear with us. In the next 1 or 2 minutes, we should get started. Thank you. All right, good afternoon again to everyone. Thank you so much for joining us for this virtual event, which we hope will be very informative, but at the same time, it should be efficient indeed. My name is Wale Famru. I'm delighted to be moderating the session, but you'll be seeing me very briefly because in a brief moment, I will be inviting our first presenter today. So this event is themed Seeking Alpha. How do you position? And we look forward to unpacking the current investment climate. And we look forward to sharing the thoughts of the resources that we have here at CardinalStone. So one thing I will say is that as much as possible, get ready to be informed, but at the same time, also be ready to participate. And you would find the Q&A field on your screen, depending on if you are joining from, well, typically it should be somewhere towards the bottom of your screen, but please look for the Q&A field. We hope that will be your friend as we progress. We look forward to receiving your questions. Any questions that you may have as we proceed, please feel free to share them in that field. And if you do have any comments as well, you can feel free to share them in the chat field as well. But the challenge with that is that it could potentially get lost. So as much as possible, we strongly encourage that you put it in the Q&A field. So we have quite a range of participants today, comprising HNIs, institutional investors, retail investors. You're all welcome, and we look forward to informing you today. So let's get started. So without further ado, I'd like to invite to make the first presentation, the head of research at CardinalStone, Philip Anegbe. The next voice you'll be hearing will be his. I strongly recommend that you pay close attention. And as I mentioned, please take down your questions and we look forward to unpacking them later on. So on that note, it's over to you, Phil.
All right. Good afternoon, ladies and gentlemen, and thank you very much, Wale, for that introduction. We're excited to have you participate in this conversation. We're all seeking alpha in a very uncertain time. There's fear, there's confusion, and there's uncertainty. But then that does not mean we don't have to invest. There are always opportunities. But then we start by discussing growth and the markets. What's the relationship between growth and the markets? What are the socio-political changes or insecurity-related issues that could actually impact growth? Then we talk about structural setbacks that we've been experiencing for a couple of years. We talk about policy-related issues. We talk about issues related to currency. And we try to unpack all of that and try to distill the impact on the fixed income market, on the equities market. And of course, we close by trying to work out some sort of possible asset allocation for 3 class of select investors. So join us as we progress, starting with growth. So what's the expectation on growth? For growth, we say that the expectation is a global bounce. In the Outlook report we presented, we talked about the bounce. We preached the gospel of a bounce across global markets. And that gospel is coming to reality. For one, Nigeria experienced its paciest GDP growth in over 25 quarters in Q2. And we saw decent growth numbers across various markets, as shown in the charts above. You see, for different economic blocks, there were decent growths relative to the setback that we saw in 2020. And the interesting thing is that it appears that this growth expectation is being priced into asset valuation. We are seeing equities, for one, responding positively to growth expectation across key markets, as shown in the charts below. But for Nigeria, it appears that this growth expectation has not been fully priced in. The equities market is currently below the waters. And there are several factors accounting for this, several encumbrances. And these encumbrances includes weaker earnings, particularly for stocks in the consumer goods space, plagued by significant pressures as a result of higher commodity prices that drove margin contractions for a number of these companies. And you also have the little issue of yield uncertainty. I think in Q2, there was significant yield increases relative to what we saw at the start of the year. And yield increases, as you know, would always have negative impact on equities price or valuation. And of course, FPIs have remained on the sidelines, plagued or irked by lack of pro-market initiatives, particularly issues or concerns around the currencies. But aside these factors, there are other good considerations that we would like to look at, such as sociopolitical and security-related issues. We believe that sociopolitical issues or security-related challenges have significant ramifications for growth, particularly the agri sector, which constitutes about 25% of the total economy. We know that several insecurity-related issues have actually capped the growth for the agri sectors at between 2 and 3.5% for quite a long time. So we believe that this is important in the discussion of economic outlook going forward for the rest of the year and even going into 2022. And insecurity also has ramifications for cost of doing business. For one, insurance premiums may be repriced as a result of insecurity. Take a look at the aftermath of the NSAS process, or of the NSAS protest, as well as reactions to the xenophobic attacks. This led to material damages. They may actually stoke a renegotiation of certain insurance premiums. And of course, that will have implications for the costs of doing business in the country. And then we still have to worry about the little question of election-related concern, particularly as we go into the pre-election year 2022. Election-related crisis could actually worsen socio-political outlook in the country. And of course, could lead to capital flights and of course, maybe flights to safety across the markets. As we've seen in the last 3 political cycles, I think equities market was mostly weaker. But then, in addition to the security and the socio-political considerations, there are other structural issues that have been plaguing the country for quite a while. We cannot go past subsidy when it comes to these other structural issues that have been dragging us down. Subsidy is topical. Subsidy is important. And we believe that its removal could actually stoke or drive some medium to long-term positive implications for growth, budget deficits, as well as lead to some dollar savings. On budget deficits, we know that provisions for subsidy allocations constitute over or close to $1 trillion, right? You put that in dollar terms, it's closer to the 3.3 billion we are looking to even raise in Eurobond. How would it feel to allocate a sizable chunk of expected Eurobond raise to subsidizing PMS? So it's a bit concerning. So those structural issues will have to be addressed in order to put the nation on the path of sustainable growth going forward. However, removal of subsidy is a tough decision to make. It is not easy, it is politically hot. And as such, the government may actually follow the pattern instituted by several African countries or several related countries that we know. The provision of safety nets may be important, at least to pacify the citizenry as it looks to actually institute energy reforms. Away from this, the monetary policy concern of currency is important, and how currency is handled going forward is very, very crucial for growth outlook. We believe that the CBN may have to step up its policy intervention around currencies. Thankfully, there are some near-term indicators that suggest that some reprieve from the currency-related issues may come soon, maybe sooner rather than later. And those reprieves would come in form of the expected Eurobond raise of $3 billion. There is the little SDRO allocations. We're talking about $3.4 billion. And of course, in the news recently is potential $4 billion in foreign borrowing. So all of that could provide some short-term support on the currency front. Looking at these in isolation would suggest that reserves are going to go up, or maybe the outlook is a bit not as pessimistic as people expect. But you will have to look at all of these factors vis-a-vis the dollar liabilities that have been pressing, right? On the dollar liability front, we have a stack of FPI backlog. We have unrepatriated dividend. A number of investors, foreign investors, have not repatriated dividend for close to 2 years, or maybe even more. And of course, you have CapEx need of the government that will require dollar financing. You have CapEx needs of the institution that will also require dollar financing. So all of those constitute some sort of FX liability that will have to be met. So put that into the mix, you will see that the gains identified at the start of the discussions in this slide may actually be short-lived, except other measures are put in place to actually strengthen the FX liquidity position. According to the CBN, the Naira is overvalued by about 12% at the INA window. I know this may cause a number of us to look and maybe try to ascertain what is going on in the parallel market to try to make sure that the CBN is really in touch with what is actually going on in markets. True to it, the CBN estimate is actually related to what goes on in the INA window, right? And we believe that this estimate suggests that the CBN may be estimating a fair value of the Naira closer to 470, which coincidentally is also close to our fair value estimates for the Naira internally. We believe that activities in the parallel market is largely impacted by speculative activities. There's fear, there's uncertainty that is actually driving a lot of the activities there. And unfortunately, it is difficult to forecast the parallel markets because it's not as transparent and probably not as open as you would have wanted it to be. However, what we feel is important is the need for the CBN to step up its plan to actually maybe improve supplies to the markets. And that improved supply would have to be complemented by policies aimed at actually curbing speculative activities. That may require raising rates. That may require being a bit more aggressive on liquidity mop-ups, because these excess liquidities will definitely find their ways to certain pockets. And if the opportunity to play arbitrage in the FX space continue to linger, you still find that the pressures we are seeing in the parallel markets may succeed. So there's a need to react. And that expectations for tighter liquidity leads us to believe that yields are actually likely to trend higher as we go into the coming months. We expect that all eyes will be on the CBN as the policy meeting continues. Our expectation is that sooner rather than later, the CBN may actually raise rates and tighten liquidity in order to, on the one hand, encourage FPIs to begin to reanalyze or reevaluate the Nigerian investment case, and on the other hand, to reduce Naira liquidity to prevent or cap or limit, if you like, speculative activities domestically. There are other factors that actually support our expectations for yield increases, such as the probability that we may in fact not get all the foreign borrowings we are planning to get for 2021. The expectation is to raise $6.2 billion in foreign borrowing. Okay, this is October, and this is almost the end of the year. We're talking about raising just $3 billion in October, right? So there's a strong chance that we may not get all the foreign borrowings we are seeking. And that may mean that domestic borrowings may actually be more than was previously expected. In addition to this, there is the little issue of pre-election related concerns. And typically, in pre-election years, you may have more volatility, and we think that it will just tilt to leading to higher yields, right? So in the face of this, we advise investors to pick a strategy of being short duration to remain nimble and to take advantage of yield increases when they occur. Coincidentally, or maybe on the negative side of things, yield increases may not augur so well for equities. So equities and yield increases, I did mention at the start of this presentation, is likely to be unfavorable for equities, yield increases, right? We saw that in 2020 when moderation in yield led to good equities performance, particularly in the second half of the year. And of course, going into 2021, yields have been very important, particularly in Q2, right? In shaping the outlook for equities, it's also important to consider growth. But unfortunately, markets have not reacted to growth numbers. And markets also did not react positively to earnings releases, right, which was largely mixed. So we believe that investors' focus could be on yield direction, as well as sector and company-specific fundamentals, right? We believe that there remains opportunities to actually cherry pick even within this market. This is
Right. Philip, my apologies for jumping in. Wanted to get your perspective a little bit on a couple of points that you've raised. And I want to perhaps use that to use the balance in Nigeria, ginger others to participate and ask more questions. So you mentioned, first of all, that which I think is quite important, that you think that yields are likely to trend higher in the coming months, and you have a bit of a bias or that the MPC would raise rates. The big question for me now is, which is quite an interesting observation, but where do you think rates would go vis-a-vis inflation? Because on one hand, inflation is trending lower, but then you are proposing that perhaps rates may go higher. Where do you see that? How do you see that playing out?
Yeah, thank you very much, Wole. I think that's a very useful question. I would think that the yield increases may be a bit staggered, right? You're not going to see 500 basis points, 600, 700 basis points all at once. So it may be a bit staggered. Maybe before the end of the year, we could see some 100 to 200 basis points. And then as we progress into the pre-election year, yields may actually continue in that direction. So that is our expectation. So 100 to 200 basis points this year, and then it continues in that way as volatility intensifies in pre-election year. I don't know if that addresses your question.
Yes, absolutely. I just thought to raise that point, which is an important one. But then maybe you could give a little more color in terms of specifics. So inflation is at 17 right now. Where do you see T-bill rates going? Where do you see bond rates going?
Yeah, we think that we will continue to see negative real return in the near term, right? To be clear, inflation is about 17%. The yield on the one-year instrument is sub 10%. So the negative return is likely to subsist in the near term. But then what we believe is that we will see gradual narrowing of that spread if the CBN really moves to actually check the currency impasse that we are facing. I mean, the rates at the parallel market is closer to 560. Months ago, it was just over 400. So it's really concerning, right? So it's really concerning. We expect that currency is likely to be a very topical issue and in the ongoing meeting, in the ongoing MPC meeting. So the CBN may actually look to address these issues head on. It has placed already restrictions on BDC sales. And of course, there's a likelihood that we may see more unorthodox measures directed at actually controlling activities in this space. We believe that flows of dollars in the form of Eurobonds and maybe other borrowings and SDR allocation will also provide some more leg room for the CBN. But like we stated clearly here, we think it is important to also raise rates to accompany these other positive developments, and of course try to reduce Naira liquidity to control speculation. So we think that these are steps the CBN is likely to take going forward. And of course, it's consistent with what we've seen in the course of history. Historically, the CBN has always gone this route to actually tackle rates or exchange rate related issues at the parallel market.
All right, please go ahead.
Yeah, so thank you very much, Wale. So we'll just go ahead with the presentation. So we're saying that yields will go up and typically not positive for equity valuation. At least that's investment 101. I guess most of us know that already. But then we believe that there are still likely to be opportunities for those savvy investors who will be able to cherry pick within this space. Take the last 5 years, for example. In 2016, there was a recession. People were very negative. People had very negative perception of markets. Expectations were really, really not very good. But then it provided attractive entry opportunities for a few investors. And looking back, you realize that a few investors who placed their bets on sound, fundamentally strong equity names may have ended up on a positive note. Now, if you look at equity returns on an inflation-adjusted basis, for the broad market, I think the market was down by about 25%. But yet, there were certain stocks within the market that reported the positive inflation-adjusted returns, such as Zenith Bank, for instance. Positive adjusted inflation return of about 70%, we think is really decent, right? For Como, if you had bet on Como in that period, you would have gotten something close to about 61%. There are a few other stocks that actually provided positive real return, inflation adjusted stocks like Dangote Sugar, and I think Seplat, and a few other names. So we think that for the savvy investors who follow sound, fundamentally strong companies, there will always be latitude for some gains. However, not all investment is right for you. We've talked about fixed income, we've talked about equities. I think we did say one or two things about currency, right? But we believe that fear, confusion, uncertainty should not deter you from investing. As a matter of fact, it could provide opportunities for investing. This is a phase, and every phase comes with its own opportunities. As seen in the illustration, the 5-year illustration I did, certain stocks are performing on an inflation-adjusted basis. So it's important to know yourself. It's important to know your risk appetite, to know your return objective. It's important to know your investment horizon. It's important to speak to an investment advisor to guide you in the decision process. And in order to close this discussion, we do a small hypothetical analysis where we try to draw up some sort of an asset allocations for 3 classes of investors. A very conservative investor, say an elderly man or woman closer to retirement, who is not willing to take risk, is just preparing to say, okay, I just want to maintain my lifestyle, say, for the next few years, right? For such a class of investor, you expect that investor to be heavy on fixed income related products, say an 80% allocation to fixed income, and maybe 20% allocation to risky investment as equities. So let's even assume a 2-asset for equities and fixed income. So 80-20, right? It's our recommendation for this class of investors. Obviously, with this allocation, you expect that risk will be relatively lower. However, there is a world where some individuals may feel that they have bigger stomach to accommodate more risk, right? They have more latitude to accommodate risk. Let's say a middle-aged man or woman that is still working, right? Willing to take some risk, but unwilling to lose the complete principal in investing. Such individual may have moderate risk that in our view would fit a 50% allocation to fixed income and another 50% allocation to equity, at least moderate exposure, right? Of course, this individual may be subject to higher risk relative to the conservative investor, but of course, you expect that this risk could potentially increase probability of making better return relative to the conservative investor. But what if you are young, say in your 20s, a young lady, say a medical doctor, could be a banker, could be a teacher, so nobody's really left out, right? Young and maybe with stable income and looking to actually invest. We believe that for individuals who are young, for example, they have probably low financial capital at the moment, but their human capital is still very robust because they still have a lot of years ahead of them. And let's assume they have stable income. For such class of investors, because portfolio management 101 would say they may have better capacity to take on more risk. So we recommend 80% investment in equities and 20% in fixed income. Coming at with expected higher risk, coming at the expense of with expectation that returns will be far better than that of the conservative investor, higher than that of investors who is just taking moderate risk, but of course it's going to come at the expense of greater risk. So we close. This is where we call the presentation to an end, and we do hope that we will get good participation and comments. Comments are welcome. Questions and answers are also welcome. So thank you once again for participating. We are happy. Thank you.
Right. Thank you so much, Philip. Very enlightening presentation. I see from some of the comments that it does appear that some of the content of the presentation may have been a little technical for some of our participants, but at the end of the day, I think some of his key messages came through. He spoke about the thoughts around the central bank's view of the Naira, that we have heard comments that they feel it's overvalued by about 12%. So that should suggest that there could be some adjustments further down the line. And then, of course, I think one of the big takeaways around the conversation around the monetary policy situation is his expectation. Contrary to what many analysts are saying right now, that it's unlikely there will be any rate change at the ongoing MPC meeting, he's anticipating that potentially we could see a move towards a more tighter monetary policy stance to attract the foreign portfolio investors as the central bank gets its act together concerning the currency. So this is the time for us to get your questions, and I can see that some are already coming through in terms of questions and comments. So we're going to jump right in, and we're going to start taking them one after the other. So again, I want to encourage you, if peradventure some issues that you were thinking about concerning the outlook for the economy or the various market segments, please feel free to share your questions, and the team here will be very happy to take them. Rest assured that we also have, if you like, more resources, more reinforcement in terms of analysts who are supporting Philip here. So they are all here to take your questions that are specific as they may be in terms of the equity market, maybe specific companies, specific industries. Maybe you are looking at your portfolio right now and you're trying to make a decision in terms of what to do. They're all here and they'll be happy to take your questions. All right, so let's get started with a few questions. I'll start with one coming from Kelvin Awani, and he's saying, how do one get annualized returns of over 14% for the low risk investor when the T-bill rates are low? So I imagine that he's speaking to your asset allocation call there. Do you want to clarify a few points there, Philip?
All right, thank you very much, Wole, and thank you for the question. It's important to note that when you fashion a strategic asset allocation is for the longer term, right? So when I say the conservative investor is likely to get a return in excess of 14%, I'm saying return over the long term. So it's long-term annualized expected return. Now, if you look at the FMDQ bond index, right, you look at its annualized return over the last 10 years, about 14.2%. So it's not really far off, right? And that's a bond index, about 14.2%. Now, this individual is assumed will take up some equity exposures in addition to fixed income, right? So if his expectations pans out, you expect that he also gets some returns from equity investing, right? He works with, probably works with very competent advisors who guide him on the equities leg of his portfolio. That the returns from that leg also augment whatever he gets on the fixed income space. But it's important to note that these are long-term annualized returns. So there's volatility, right? There are some years where the returns will be sub 14%. There's some other years where returns will be higher. It's expectations, right? So it's a longer term return and it's consistent with the annualized return for fixed income investing over the last 10 years, looking at the FMDQ bond index numbers. Thank you very much.
Right, thank you, Philip, for that. But coming back to the discussion around asset allocation, maybe to make it even more valuable to the audience. So typically, as you mentioned, we have different buckets of risk tolerance vis-a-vis return. What exactly are you recommending in terms of those who are already in those buckets? So for example, if someone is already skewed towards a more conservative investment style and risk tolerance, are you proposing that, for example, they should increase their fixed income allocation at this time, or should they pretty much stay where they are at, assuming that they are already at the 80-20 split that you are proposing here? And then likewise, if you can just speak to what you think those who are in the other bucket, who are more in between, and then those who are more aggressive.
All right, thank you very much, Wole. The expectation is that once you've worked with your investment advisor, you come up with an IPS, investor policy statement, you stick to it, right? But then there are instances where conditions change. If your conditions change, your profile changes, of course, you can go back to your investment advisor and you can reconfigure the investor policy statement, and it really affects how you play. So essentially, that's what we're doing.
All right, so stay close to your investor advisor. I think that is a big takeaway there. All right, so a small clarification that I think one of our attendees is seeking here. Somto Chuba is asking, when you say long-term, how many years on average are you referring to?
All right, thank you very much. In our analysis that we did, particularly for our efficient frontier, that's where we had the different asset allocations. So the numbers you see were from an efficient frontier that we produce internally. And we use a time period of about 7 years. We use 7 years data. So if I say long term, I'm saying 7 years. You can say 7 to 10 years, right? Thank you very much.
All right, thanks so much, Philip. I see that we have a few people raising their hands, and I imagine that they would like to ask questions. We'd like to appeal to you to please type in your questions, because we are not unmuting for you to be able to speak. So please bear with us. We'll appreciate if you can just type in your questions if you have any specific questions. All right, let's go back to the Q&A field and see what else we have. Now, Olukayode Oluwole is asking, I am worried about qualitative aspects of some comps on the stock markets, and your analysis are more quantitative. We'd like to see you give some insights into agri. So I think he's asking specifically about, speaking off the cuff in terms of your expectations for perhaps sectors like agri, as he has highlighted here.
Okay, thank you very much. For our agri coverage, we are broadly positive on Presco and Okomu, the two listed stock. I'll take the case for Okomu first. I think Okomu, they've been really expanding capacity, and it has helped that restrictions on border-related activities has also ensured that they continue to grow their market share domestically. It's been broadly positive. In addition to that, CPO prices have been really, really decent. At some point, I think even now, CPO prices are about, say, strong double-digit higher on a year-on-year basis, and that has really provided support for Okomu. In addition to Okomu, in addition to the CPU and volumes gain, you find that they have very strong regulatory support. There are different facilities from the CBN and different agencies that are geared towards supporting these listed companies. I think at some point, I think as at FY 2020, that's full year 2020, Okomu's total debt was 100% concessionary facility. And that's some positive. That's ensured that its interest expense is really, really controlled. So Presco also has certain other positives like Okomu, right? They enjoy certain other benefits. Positive CPO price is also good for them. They're also looking at expanding. So we think that the medium to long-term outlook for these companies remain positive. And another takeaway is that their return on equity over the years have been at least relatively better compared to what we estimate to be the cost of equity of markets. Thank you.
All right, thank you very much, Philip, for that. All right, so let's go back to the Q&A field and take a few more questions. Somebody is making a point here about the importance of BTC in the economy. This is from Ahmed Babatunde. BTC. Oh, of course, I was beginning to think what that meant. Bitcoins, I guess. Okay, so do you want to comment on that, Philip? Any thoughts on how that is impacting our economy?
Thank you, Wole. But we would excuse ourselves out of that because we're not allowed to comment on unregulated products.
All right, that's noted. Okay, another question from Henry is, can you please drill down to sectoral brands with green probability in the equity space? So maybe you can just speak specifically to the sectors that you think are likely to outperform the market.
All right, thank you very much. In terms of sectors that we believe they will still see potential strong upside, say over the next 12 months, we mentioned agri already. We see potential opportunities in agri. And interestingly, I mentioned that Okomu on an inflation-adjusted basis has returned great value to shareholders over the last 5 years. And we still see strong potentials in the agricultural space. So those two companies, watch out for them. In addition to that, we still see some value in the cement space. I would think that there's potentially a very strong upside to be realized in a stock like WAPCO, for instance. We think that it's relatively underpriced, right? It's relatively underpriced, right, relative to our fair value. So there are opportunities. And of course, continued infrastructural deficits and, infrastructural gap essentially continues to be supportive for investments in those names. Following their balance sheet restructuring, and of course, the sale of the South African business, we think that they've actually stepped up the gear. So we're positive on the cement space. We're also positive on oil and gas, right? The Petroleum Industry Act, we believe, is likely to drive greater transparency and encourage greater growth in the space. We also believe that potential deregulation could create significant value in the downstream space. Just on a margin basis, we think that deregulation could unlock between 300 to 400 basis points in margins improvements for downstream companies. So that suggests that if a deregulation indeed happens, value can be unlocked. So investors who will benefit from this are those savvy investors who will need to cherry pick within those spaces, even now that valuations are still depressed, right? And we're also positive on telecoms. We believe that data remains a very strong fulcrum for growth, driving the telecom sector. So we're positive on telecoms as well.
Can you give a quick comment on the banking sector very quickly before we take a few more questions? Your expectations for that?
So for the banking sector, we are essentially neutral. We believe that lower impairments is likely to be supportive given the recovery in economic activities. You expect that impairments are likely to be lower relative to last year. That's supportive. But then lower yields could actually impact interest income negatively. So it's a bit of a mix, right? Lower impairment benefits being offset by impact of lower yield. But banks that could proactively make moves to actually boost fee and commission income in line with the growth in the economy are likely to also perform. So we're neutral on the banking space.
All right, let's go on to what I think is a very important question right now. Given all that has been happening with the exchange rate, how do you see the FX settling by year end? So John is asking that question. It's a question that many people have asked me. I'm sure it's a tough question to answer, but it's yours, Philip.
Yeah, thank you very much, Wale. FX is on the table of every investor in the country, expectedly. CBN has said that, has admitted that the Naira is 12% overvalued at the INA window. So that suggests that a repricing of the currency is very much a consideration for the Apex Bank. In our view, we think that the Apex Bank may move to gradually reprice the currency. So we're not expecting any sudden change in it, like any huge change, any huge one-time change, right? We expect a gradual adjustment in the currency at the INA window. So we have a forecast of 425 Naira to the dollar is our expectation. It's our base expectation for 2021, right? But after that, you expect that as opportunities come, the CBN will look to try to reprice the currency in line with its guidance that the currency is about 12% overvalued. So that's what we think will pan out in the official window, the IME window. Thank you.
All right, thank you so much, Philip. Another question relating to foreign exchange. Would the proposed Eurobond issuance significantly impact the liquidity in the equities market, especially for the foreign portfolio investors? I think that's an important question because obviously we know from history the foreign portfolio investors do have a huge say in the outlook for the equities market.
Yeah, thank you very much. And I agree completely, it's very important. In the course of this presentation, we did say that there are certain indicators that suggest that we may have some temporary reprieve. So I'll just repeat that. So temporary reprieve, the Eurobond, $3 billion, the SDR allocation. But we think that the reprieve is likely to be temporary because we see from indications from our conversations with our sector coverage companies that there is still a huge FX backlog that is still needed. We have still need that the country still needs to clear, right? Outside of equities, you have estimated FX backlog of demand of about, say, less than about $2 billion. So all of that will have to be addressed. So there are a number of issues, right? And you look at CBN's normal intervention at normal intervention, say prior to 2020, where we had this crisis, you discover that if you go at the rates of intervention at relatively normal times, you see that $3 billion may not be enough to take us for so long, right? You may just be able to provide some, maybe a month or two of reprieve, and the CBN will definitely have to complement the expected Eurobond borrowing with other initiatives, like I've mentioned, maybe raising rates, and maybe trying to be tighter domestically to curb speculation to control the currency. So temporary reprieve, yes, maybe, but then a lot will depend on those other variables I mentioned.
All right, thank you very much for that. There is a question here. What are your top 5 stock picks? I would probably request that perhaps the research team can just type in a response to that, and maybe we can read that later. But another more specific question Is it advisable to liquidate one fixed income investment portfolio? That is bonds for purchase of dollars. So I think this is perhaps suggesting how weak, it's trying to test your thoughts on the potential weakness of the Naira moving forward. Would it make more sense to be invested in dollars vis-a-vis being invested in bonds right now?
Well, I think this is a very interesting question. I was having a conversation with a friend, and he said you get 7 to 13% in fixed income investing, right? And people speculate and get over 30%. Unfortunately, we don't forecast the parallel markets, so we are focused on the official markets. So officially, we think that at the INA window, the repricing we could see could be maybe to 425, right? To 425, that's about some relative to the 412 that we have, some 13 Naira in gains, right? If you are able to access the INA and the devaluation happens on that front. But essentially, we think that there are still opportunities that are likely to be opened up, right? So there's room to invest. If you want to have exposure to dollar, there's room to invest in dollar-related products that could provide you that exposure that you need. So in addition to whatever currency repricing benefits you could get, you could also add the yield returns on those investment products, right? So I would recommend having a proportion of your portfolio invested in dollar-related products.
All right, thank you very much. So another question here is threefold. We commend your brilliant presentation. The first one, I think we have touched already. Where do you see the US dollar Naira 1 year exchange rate forward from the binoculars of CardinalStone? I think you've spoken to some of the expectations there. The second question is, with the growing domestic and foreign debts vis-a-vis almost stagnant or reducing revenues, can you kindly elaborate on the effects of this growing debt on the financial markets? So I think that's a very relevant one. And then what are your thoughts on the e-Naira vis-a-vis on our financial markets and the economy? So will that also have any impact? You want to touch that quickly?
All right. Thank you very much for the question. We think that debt service to revenue ratio is not looking good at the moment. It's a bit concerning. I think the estimate is about 90% or in excess of 90%, suggesting that for every 1 Naira earned, about 90 kobo at least is spent servicing debts, which is a concern. It also speaks to the need of actually removing fiscal encumbrances like fiscal drawbacks, right? Trying to be more disciplined on the fiscal space. And it also may also speak to the need of looking at removing subsidies that could actually provide some fiscal space to support the country going forward. So yeah, we think that those factors are important and could influence the direction of things. On e-Naira, we think that it has the potential to improve financial inclusion domestically, but then it could actually negatively impact banks, especially when you're looking at it from the fee income perspective. So we just think that it's broadly going to have mixed impacts. On the one hand, better financial inclusion, but then negatively impact banks in terms of but we're still early days, so we'll see how events unfold. Thank you.
All right. Can you speak very quickly on this one? The MPC is currently in session. What are your expectations? We still have quite a few questions, so if you can make that.
Hello, would you mind taking that question?
Yes, I am asking, what are your, the person here is asking, what are your expectations for the MPC? The MPC. This one that is in session right now.
All right. expectation is that there will be a relatively greater leaning to trying to tighten things a little, right? But this may not necessarily lead to interest rate adjustment at this meeting. But what we think is that the arguments will be firmed up, and maybe through some other means, maybe not necessarily altering MPR or CRR, so maybe through some unorthodox measures, they will look to tighten things a little at the least, right? But then maybe towards the end of the year, say the next MPC meeting after this, the arguments for adjusting rates will be stronger. So we think that before the end of the year, rates may actually be tinkered upward. But for now, we think that stronger leaning towards tightening, given the realities in the FX market. And of course, they have the extra assurance that we've really rebounded relative to the growth issues that we had last year. Thank you.
All right, thank you for that. As we begin to wind things down, and we are still going to do our best to get to every question before we wrap. But there's a question here on, can you quickly review the current status of GTCO and WAPCO shares, price relative to your current projection for the end of the first half of the year? I believe what that means is perhaps this person has seen your projections and you would like to get an update on this.
Yeah, so I'll start with WAPCO. Like I said, we see significant mispricing for WAPCO. And if you ask us in the cement space, it's our top pick. We think relative to the other stocks in the cement space, WAPCO is materially underpriced. Then in terms of its cost per ton, we think it has really done a lot to catch up with the big players in the space. Of course, Danksem is the clear leader because of its capacity size, huge capacity concentrated in just one location. With Bajana, we're talking about a company that has about the biggest plants in the whole of Africa. So, but we think WAPCO is closely catching up. It has invested significantly in using alternative fuels, coal, and several other options as opposed to expensive energy mix that we've had in previous years. Then, of course, it has done a good job in restructuring its balance sheet. That is really very crucial. Once upon a time, WAPCO was laden with significantly high foreign debt in their books, and that was pressuring interest expense, right? But they've done a lot of restructuring, so is South African business that was margin dilutive, structured their balance sheet, and of course, they look well on course to progress. Then on GTCO, we are positive on the restructuring drive of the company, of the bank, to a good structure. We believe that it's positive in the long term, positive for earnings because it helps them to diversify their earnings, right? Diversify ROE, sources of ROE, and also diversify earnings. And it could also lead to stronger performance in the next few years. And we think that GTCO is really very cost efficient, decent cost to income ratio, strong capital buffers, strong bank. Thank you.
We can just come back on GTCO very briefly because we do have to wrap things up now. Were you disappointed in their performance for the first half of the year? And typically, GTCO is the market leader, but then quite clearly, they were under some pressure this time.
Yeah, thank you very much. Yeah, quite disappointed. I think below our expectation in terms of the earnings numbers. But then our view on the bank is shaped by expectations for the next 5 years, right? They have this patch. We believe that the bank is in the right, it's making the right steps to actually leapfrog the current impasse. And like we said, we are constructive on the restructuring program. I believe that is going to provide relative stability to the bank going forward. Yeah.
All right, thank you very much, Philip. We'll have to perhaps pause on the questions now because as I mentioned earlier, we would like to be as efficient as possible, but to the extent that we can, we'll probably type in responses, the research team will type in responses to other questions that have come through before we wrap. But as in Philip's last response, he did speak about thinking long-term about GT code. And now we would like to also turn your attention to a service that really is for those who are long-term oriented. And I'd like to just turn your attention as we roll a short video on one of the subsidiaries of the CardinalStone Partners Group, CardinalStone Trustees.
Hi, I'm Emma, and I would like to introduce you to CardinalStone Trustees. CardinalStone Trustees Limited is a SEC licensed trustee and a member of CardinalStone Partners. Our sole business is trusteeship, as we play a key role and act as intermediary in financial and non-financial transactions. We provide best-in-class services to our wide array of clients with our areas of specialization as trustees in but not limited to private trust, public trust, and corporate trust. Our private trust service offerings range from estate planning, wills and executorship, endowments and foundations, living trust to investments and trust. As trustees, we represent the interest of bondholders/unit holders in transactions such as FGN-backed bonds and state bond issues, collective investment schemes, real estate investment trusts, and more. We also act as trustees to corporate bond issues/private note issuances, debenture trust under consortium finance/syndicated lending or project finance, as well as structured finance transactions. To learn more, kindly speak to a trust advisor on 01-7100-433 or email trustees@cardinalstone.com. CardinalStone Trustees is here to serve you.
All right, so there you have it. Very important information that you can use. The CardinalStone Trustees services are relevant not just for institutions, but indeed for individuals. There are an array of products that you can use. And as mentioned, the contact phone number to hear more is 01700-433. So as we begin to bring this session to a close, and as I did promise, those questions that we haven't had an opportunity to answer, the research team will be typing in their responses. So please stand by to get those responses. But in the meantime, I'd like to now invite the Managing Director of CardinalStone Securities, Elile Olutimai, to deliver some closing comments as we wrap things up. Elile, it's over to you.
Thank you very much, Wally. I want to say good evening to everyone. Thank you so much for taking out time out of your very busy schedule to join us today for the session. We know that there are many moving parts, and the biggest, the elephant in the room is FX. We hope that we've been able to address some of the concerns you have and questions. We also know that the outcome of the MPC meeting tomorrow would also shed more light as we try to navigate this new era filled with so much uncertainty. But we want to assure you that at CardinalStone, we remain committed to helping you. So any way that you think that we can help you in making this journey less, stressful, and helping you, achieve this alpha, this optimal return that we all seek, please feel free to contact your investment advisor. If there are questions you have, we have our email address showing on the screen. Please feel free to also contact us. We'll be ready to, help you in achieving your investment objective. Thank you very much, everyone, and do have a wonderful evening.
Thank you, Elile. Very well said. And once again, I want to appreciate everyone for joining us this evening. I hope it has been useful. I hope we have been able to shed light on certain areas that you needed some clarity on. And as she mentioned, please feel free to contact the team even after this. I think there was one question that we didn't answer concerning whether or not you can receive the presentation. I will just simply say, contact the team, and I believe that they will be happy to share the presentation with you. So that note, thank you so much. And we are still typing in the responses. So if you stick around, you will still get answers to your questions. But to everyone else who is joining us today, thank you very much and have a great evening.